too much inflation or you're stuck with too much economic weakness. Navigate through the middle, and that means something like stagflation.
Stagflation, the term that sounds like inflation's cool older brother, but in fact makes Turkey's hyperinflation problem seem like a smudge on the economic lens. Stagflation is when high inflation occurs at the same time as a recession. So not only do businesses fail and people lose their jobs, the cost of living will be rising at the same time. So in today's video, I'm going to be breaking down Ray Dalio's thoughts on stagflation and what it means for investors today. And if you enjoyed today's video, make sure you hit the subscribe button. First of all, I nor anybody, including Ray Dalio, have any idea exactly what is going to happen when it comes to the economy in the future. There are warning signs like the current and increasing inflation level, the yield curve inversion that has preceded every single recession for the last half century, but we will never for sure know exactly what and when is coming for the broad economy. So while this video will help you understand what stagflation is and how Ray Dalio thinks you should be investing during a period of stagflation, you should never try to predict what is going to happen in the broad economy and invest based on that. Trust me, it's a waste of time. It's a much better plan to learn how to invest so that you're protected regardless of what economic circumstance comes up in the future. Stagflation was a term that was first used in the UK in the 1960s, and it essentially describes an economy which has three features: high inflation, slow or negative GDP growth, and high unemployment. And until it occurred in a big way in the 1970s in the US, many economists actually dismissed the idea that this kind of economic situation was even possible. And this is because, typically speaking in economics, when we have a period of high inflation, it is usually driven by abnormally high demand for products and services, which in turn will be displayed in high GDP growth and low unemployment. Essentially, if businesses are doing well, then they will be hiring a lot of people and doing well financially, which ultimately drives high inflation. And on the flip side, if the economy is in recession and many people are unemployed, typically the low economic spending presents itself as low inflation or even deflation. But over time, economists started to figure out that inflation can be driven from two directions. It can be driven from the demand side, and we call that demand pull inflation, but it can also be driven from a supply shock, and we call that cost push inflation. If the economy faces a supply shock, such as the ongoing supply chain and shipping delays, or the oil shock which has been caused by the conflict in Ukraine, it's possible for the economy to experience both a slowdown in the economy and high inflation at the same time. So instead of the typical circumstance where increased prices causes an increase in supply, if there's a bottleneck on the supply side, an increase in prices can be met with a slowdown in economic output, ultimately resulting in stagflation. This most notably occurred in the US in the 1970s, where the first shock occurred in 1971 when President Nixon imposed various wage and price controls, which are believed to have created a supply shock and increased inflation. And then in 1973, OPEC constrained the global output of oil, resulting in the 1970s oil crisis. There's also a number of alternative views on how stagflation can occur. One popular alternative view is that excessive monetary stimulus from the Federal Reserve can initially drive the economy and drive high inflation. But once the Federal Reserve starts to tighten monetary policy, it may do little to affect the inflation, but hurt the economy underlying businesses, ultimately creating an environment where you have slowing or negative GDP growth, a recession, at the same time as surging prices.
There is a thing called a monetary inflation. That's when you can have stagflation. Means that even when the economy weakens, inflation rates rise because there's too much inflation and there's the move out of that. But you can start to see a monetary inflation. The big risk is of a monetary inflation, which would come because there would be more sellers of bonds than there are buyers, and the need for a lot of printing of money.
Some combination of monetary and cost-push stagflation is something that Dalio sees as a genuine possibility. Inflation in the US has been getting worse every month for about 2 years now, and the figure just reached this week 8.5% in March. And while it's heavily debated what is causing inflation at the moment, it's very likely a combination of a number of factors. We have monetary inflation from low interest rates and quantitative easing by the Federal Reserve. There's been a significant increase in government spending during and after the pandemic. pandemic, supply chain shocks that have created huge bottlenecks in global shipping, and most recently we have the oil shock caused by the conflict in Ukraine. At the same time, economic growth in the US has been extremely strong, with annualized GDP growth hitting 6.9% last quarter, and the unemployment rate is at a historic low of just 3.6%. So with high inflation, strong GDP growth, and record low unemployment, the US is currently not seeing stagflation. At least not yet. Last year and up until March this year, the Federal Reserve has kept monetary policy very, very easy, with 0% interest rates and spending up to $120 billion a month on the buying of financial assets. And this policy has just flipped, with the first rate hike occurring last month, and starting in May, it's likely the Fed will start selling some of the assets that it's holding on its balance sheet. This is going to put pressure on the US economy, as the cost of getting debt to expand for governments, businesses, and individuals is going to go up, and that could potentially cause a slowdown in economic output.
That there is going to be, when you're stuck with two trade-offs, too much inflation, or you're stuck with too much economic weakness, then you navigate for the middle, and that means something like stagflation. And so I think we're entering a period of stagflation. And I think the political and the wealth gap issues and so on create a set of circumstances that it's not easy to get out of.
So the big unanswered questions are, if the Federal Reserve starts to raise interest rates, what impact will that have on the US economy, and what impact will it have on stemming the accelerating expansion of inflation that the US is currently seeing? If interest rate increases slows down the economy but does not do enough to slow down inflation, then the US will be entering a period of stagflation. So how does Ray Dalio think that you should go about protecting yourself against the potential of a stagflation environment? Here's a recent clip of Greg Jensen, the CIO of Dalio's investment company, Bridgewater Associates, explaining how they approach protecting against stagflation.
One of the challenges for most investors is, over the last decade, diversification has been terrible. You just wanted US equities, the more the better. Everything you moved to diversify out of US equities took away from your return, didn't even add that much in terms of risk balancing. So diversification over the recent past hasn't been that helpful, but man, is it necessary. And like you said, it's complicated because you're in this very dangerous, very volatile world. And you certainly want some commodities and some gold as part of that diversification, in our view. You want to be protected from inflation with some inflation index bonds. As part of that, you want to deal with, as much as you can, geographic diversification. This becomes a further challenge in a deglobalizing world, because you're dealing with not just economic risk, but also the political risk of where you're allowed to hold assets. And so our thought on that question is still that you want to be very careful in this world. You want to be diversified. You may take losses in one area, but the risks are very different everywhere in the world. And the risks are very different across asset classes. And it's more important than ever to be balanced, and particularly balanced to the stagflation risk that is a killer to most portfolios.
Their solution is diversification. In this case, diversification into gold and other commodities. This is because they view these assets as safe havens against the currency as it continues to spiral because of inflation. They also suggest other things such as inflation-protected bonds, but ultimately Dalio's view is to have very, very wide diversification in your portfolio so that you are exposed to all the different kinds of assets depending on where the money flows in the markets. Because as I mentioned at the beginning, while it is great to observe these changes in the economy and what is happening, we ultimately don't know what is going to happen. So having a wide diversification is Ray Dalio's view of how to protect yourself from any particular shock in a particular asset class. If you want to learn more about Ray Dalio's thoughts on inflation and how the economic machine works, I have a ton of content on my channel talking about Ray Dalio's thoughts on these things. Go check them out if you're interested. But with that said, hope you guys have a great day. See you in the next one.